right. Hi, everyone. Yes, so Scope Markets is actually a global trading and investment company. So we offer solutions to investments, depending on whether you're looking for long-term or short-term assets. And mostly we give you a platform that allows you to have access to global assets. So this includes forex trading, this includes commodities, you can trade energies, and what we'll also be tackling today, which is global shares. When we're talking about offshore shares, we'll be talking about markets, particularly in the US and in the UK market. So that's what we'll be covering. So let's get to the basics actually. What really is a stock? What is a share? Yeah. So stocks, or also called equities, are a type of a security that investors take in a publicly traded company. So any stock exchange, can be the London Stock Exchange, could be Nairobi Stock Exchange, or any exchange you have. That means they've been able to offer or open up the company to the public to be able to invest in. The money you're putting in as your investment is what the company will use to be able to now advance their business. So this is what now business, as a business is continuing to do well, that's when you come in terms of the capital market gains and returns on investment. Okay. There are two types of stocks. So we have what we call the individual stocks and what we call the CFD stocks. So individual stocks basically mean when maybe I'm looking to trade a company like Google, for example, I'll be buying one share for Google. Okay. And then now when we come to CFD stocks, now that's a different bag altogether. So stock CFDs or CFD stocks basically allow you to track the performance of an underlying stock. Okay. So you do not become a shareholder of the stock, unlike when you're trading individual stocks. Now, what does this mean? It means when a trader is opening a position with stocks, they actually, CFD actually stands for contract for difference. So it's actually a contract you have between you and another party to be able to trade this particular asset, not the underlying stock, but the particular asset performance, okay, over a period of time. So usually they're still traded on a normal stock exchange, just alongside stocks. What's the difference between the CFD stocks and the individual stocks? Now, CFD stocks come in with a factor we call leverage. Now, leverage basically means that the company you're trading with, in this case, maybe let's say if you're trading with Scope Markets, there'll be an offering of a ratio to be able to multiply the capital you have, so you're able to trade with more capital than you probably would have. So in this representation here, we have, for example, maybe I have $200, for example, and I want to trade 5 stocks for Google, right? So with my $200, I may not be able to afford trading individual stocks for Google. So what the broker does, if I'm trading with a CFD trading account, we have the leverage coming into play. So here the leverage in the pivot is represented as 50:1. So what this ratio means is that for every $1 that I have as an investor, the broker will provide 50 more of that to be able to boost my margin or to boost my capital so that I'm able to trade with much bigger capital. Okay. So in this case, if we do 200, we multiply that by 50, that means you're now able to purchase assets worth $10,000. Okay. Now that $10,000 versus your $200 is what we call the margin. So whenever you're opening your position, you'll be able to see your capital reading $200, and then you're able to see your equity. Your equity now will be the notional value in this particular case, which is now the $10,000, which now allows you to be able to purchase the assets with that amount of money. Okay. Usually, as an investor, when you're trading in assets and you're reading or in stocks in particular, so we have the basic one, which is the dividends. Basically, dividends are a portion of a company's earnings paid out to their shareholders. So for every share or stock an investor owns, they get paid an amount of the company's profits. All right, then we go to market capitalization. So to figure out a company's markets, this one is you basically multiply the number of outstanding shares by the current price per share. So for example, a company with 10 million outstanding shares of a stock selling at $30 per share, then that means the company has a market cap of 300 million. All right, then we go to spread. So spread is basically the difference between two financial measures. In this particular sense, if you're buying a stock, it will be the difference between the buying price and the selling price, what we call the bid price and the ask price. So earnings per share tell investors how much earnings each shareholder would receive if the company was liquidated immediately. So investors like to see growing earnings, and the EPS means a company potentially has more money to distribute to its shareholders. So usually if a company gets to a place where it will have to be liquidated, that means it's probably not performing, they are probably deep in debt, they're not able to stay afloat, and it'll have to be maybe acquired by another company or just liquidated. Then the EPS will be able to tell you how much earnings each shareholder or yourself as an investor, depending on the number of stocks you have, how much you'll be able to get in terms of the earnings. Okay. So usually investors categorize stocks based on investing styles and also the company size. So by investing styles, we have two categories. We have the growth stocks. So growth stocks have the potential for high earnings that may outdo or outpace the market. So growth stocks don't usually pay dividends, and investors looking at these stocks hope to make money through capital market gains when they sell their shares after the price increases. Value stocks are stocks for companies that are considered to be trading below a price that accurately reflects the company's strength. So you'll find you have very huge companies, but their share prices are quite kidogo. And if you look at maybe how the book of the company's revenue, you find the stocks might not necessarily match the strength of the company. So you find the stocks are a bit cheaper, I would say that. And these ones actually do get to pay the clients dividends as compared to growth stocks. Then the next categorization is by market cap. So market cap, or in full what we consider market capitalization, is a common way to, it's a measure of the value of a company. When you compare the value of the company, this will be the revenue, the sales, the debt, the assets, all that put together, or what we call the net value of the particular company. So microcap companies usually are range between $50 million to about $300 million. Then we go to small cap. Small cap is from 3M to about 2 billion. Then we have middle cap companies, 2 billion to about 10 bill. So generally speaking, companies with larger market capitalizations are considered older, more established, and have greater international exposure. So that means a higher percentage of the large cap companies' revenue comes from overseas. This is actually something we can look at. We have, for example, banks. In the meantime, small cap companies tend to be newer, they're less established, sorry, and they are more domestically oriented. So you'll find those companies that are starting up, but they have really good potential to be able to grow their revenue and their sales and also establish themselves a bit more diverse, but they're not yet there, but they'll probably get there at some point. Okay. So they can be a bit risky. You're asking or examples of small cap companies. So this would, for example, be one like Tesla. So it's not been there for too long. So it's just coming up. We also have Apple, we have Nike, we have Amazon, we have Walmart. But basically, an exchange traded fund is a group of assets that you trade like an individual stock. When you're doing your monthly shopping, you're going to buy food and groceries, the ones who like to buy groceries in bulk. So what you're doing is that you're going grocery shopping, but you have a basket of assets, but you're buying them as one. So I would give an example of one thing. Maybe I'm probably selling purely onions. Grace is doing purely tomatoes. Muthoni is doing purely tomatoes or potatoes, sorry, in this case. So what I'm going to do as a smart vendor, or I'm going to sell these assets or these groceries to you, but together as a package. So that is what an ETF is. So it's a basket of assets put together that you can actually trade on a stock exchange like an individual stock. All right, so you have ETFs where you can be able to have stock ETFs. So you have an exchange traded fund that has a couple of stocks in them. So instead of buying individual stocks, you're able to have a basket of maybe, let's say, 50 to about 100 stocks put together in this basket, and then you're able to trade it as one. And then we have bond ETFs. You can actually trade bond ETFs, where now you're able to keep track of the particular bond markets with this particular ETF and trade it as one asset without actually owning the bonds. And then we have commodity ETFs like precious metals, we have agricultural goods and natural resources. And then you have sector or industry ETFs. Instead of putting together maybe, let's say, just individual stocks, for example, they will track stocks in a particular sector. So you'll find ETFs that cover maybe the energy sector. You'll find ETFs covering the tech sector. Then we also have currency ETFs. So for those who've done forex trading before, you're able to actually put together the currencies, and then you can trade them as an ETF. So you're able to keep track of the particular sector. And then we have the leveraged ETFs, similar to how you trade stocks. You can also have the like stock CFDs and individual stocks. You also have the option of trading leveraged ETFs. And then there's also inverse ETFs. So this is a trading platform. So here we have NVIDIA Corporation, which is listed on the NASDAQ exchange. It's also in the US. So NVIDIA is actually a software company. So it's more or less big on the tech space. Just look at this. From the movement of that particular January, the share price was at 137.96. So you see, within a span of 3 months, you didn't have to hold on to this share for a year to actually see returns. This is just in a span of 3 months. So the good thing with a website like this, it allows you, you see, I'm not signed in, I don't know that you can see, but I'm not logged in or anything. We can probably look at earnings for NVIDIA. So if you look at how the particular company has been performing, so you can be able to see there was a steady uptrend of it. But if you can see, the company has actually been performing quite well. And then they are here. They're able to show you their earnings. So you can see the dividend yields, dividend amount per share. This is as of this quarter, so don't worry about the figures. They look quite small it's because they've been able to put it quarterly. But usually I think they do their dividend payouts annually. So when you're creating an account for purely doing physical stocks and ETFs, usually we share with you two forms. This one, so this is a client agreement form. So if you're doing UK shares and ETFs, you say there's actually no broker fee, no custodial fee, no VAT, but you will pay a stamp duty of 0.5% of the transaction value, a levy for takeover and mergers applied to buying and sell transactions when the value exceeds 10,000 GBP actually. So EU shares will give you a charge of 15 basis points on the share value per side. So basis points is actually a hundred, a 1/100 percentage of the particular pricing you're looking at. So if it's a charge of 15 basis points, and that means it's 0.15% on the share value, that is per side. So when you buy the share, and then when you close the position for whenever time you'll have held on to it for, whether it could be months or years. Now, when you close the position, meaning you have exited the position, and that's where now the other charge of the 0.15% will come in. So that's 15 basis points, okay? And then custodial fee, 15 basis points per annum. And then there's what we call VAT. When you're trading this physical stocks or the ETFs, remember you're a Kenyan citizen, and these assets are from a different country. So as of all governments, or for whatever income you're earning from those particular assets, you have to pay taxes for. But we remit those taxes for you as a broker. So I'll show you the other form you're supposed to sign in. It's called an IRS tax form. Basically, shows that you're not a resident of the US, but you're partaking in trading their assets. So on your returns income, we actually remit your taxes. For US, it's 3.4%, 3.4 cents US cents per share per side. That is for both entry and exit point. Okay, so that's about 6.8 for buying a share. 6.8 dollar cents. Okay, custodial fee again 15 basis points per annum. Custodial fee, by the way, for the custodians, usually when you're purchasing assets, you have someone who kind of holds the assets for you. That's what we call the custodian. In this particular case now, it's where we have these assets being held for our scopemarkets.com. So it's the group company level. Okay.